Thank you both for being with us this afternoon here. I'm going to start a little bit with you, Joanna, just about what the state of the market is like in your mind, given the fact that we have a new Fed chair nominee. We have interest rates behaving somewhat well over the course of the last few weeks and even months at this point, and a market that seems to be trying to figure out where the next step is going to be. What exactly do you make of all of this in confluence with each other, Joanna?
Well, I think we still see resilient economy. We're seeing through earnings reporting that companies are still faring well. The fundamentals on their balance sheet still strong. Interest rates, the yield curve looks like it's steepening, behaving appropriately with rates on the long end being higher than the rates on the shorter end. So that feels like a lot of normalization. But the markets are highly, highly responsive right now to all the news that's coming out. I think there was a waiting period in January to understand exactly what the direction was going to be with the new Fed chair. But so for year to date, there's some really strong performance in fixed income. Surprisingly, the best performing area in fixed income year to date and also last year was emerging markets. So it tells you a lot about investment and looking outside the U.S. for other opportunities too.
Joanna, how much of that trade is based upon not just the idea of diversification or mean reversion, because they have been underperforming other parts of the credit market and overall rates market for a while, and how much of that is this kind of feeling that there is a de-dollarization or some kind of a movement away from dollar-denominated assets because of what's happening here in the U.S., not just from a policy perspective, but from a sentiment perspective as well? Well,
the U.S. trade is not going away in terms of issuance across the board, corporate, government. The U.S. has the strongest fixed income market. It's the biggest opportunity set for the world to continue to invest in. It represents a lot of stability and a lot of known quantity in terms of the way corporations and the government are able to be available to everyone. But the opportunity set outside the U.S. is also very important. And so I think there could be the dynamic of, the dollar putting pressure, putting more of a view on non-U.S. assets. But the truth is, I think people are just seeing the returns from last year and looking for a way to take advantage of those opportunities more so than anything else.
Todd, do you feel the same way about this idea that we could start seeing a little bit more of a move away from some of these kind of U.S.-centric assets towards other parts of the market? And how much of that do you think is being driven by sentiment from a flow perspective? Are you seeing that play out on your side?
We are. And I think this has a lot to do with the way U.S. indices are currently constructed, right? It's no secret that you have a little bit of a concentration problem in the United States. Now, yes, some foreign equity markets are more concentrated at the top than they are for the United States. But think how much money tracks U.S. assets. So that's a lot of wealth tracking a small cohort of names. And so I think you're seeing this diversifying away from the U.S., not necessarily selling U.S., but going back into emerging markets. Like Joanna mentioned, there's a lot of good risk return there, whether it's in equity or debt, because frankly, those assets really have not worked for about a decade. So I think investors are getting smarter. They're sticking with the U.S., they're going to EM, they're surrounding with themes and all the myriad ways to play income in the ETF world. So the flow is definitely back up this idea of looking abroad, looking at other alternative ways to keep portfolio returns going.
Todd, where exactly from a flow perspective and an ETF perspective are you seeing some more of this activity when it comes to the income orientation? Is it still kind of in that traditional dividend-paying stock type thing? Are more flows going towards bond-based ETFs? Are you seeing more of these alternatively I guess, actively managed alternative income instruments that are meant to spin off income? How exactly are people playing that kind of a trade?
There's a really interesting dynamic that's happening. Over the last 3 years, flows to option income ETFs, right? The ones that sell covered calls to generate income and try to keep some upside on the equity sleeve. They've outnumbered flows compared to dividend ETFs, right? And dividend ETFs were great in the QE era, when fixed income rates were depressed, and so you had to reach for yield. Now you can get that yield from a lot of these different option strategies, and so they're about 25% of dividend ETF assets. And I think investors like that they're getting some upside, they're getting the option premium. There's different tax consequences for that. And then I also would throw down the fixed income space that money market funds have dominated flows for the last few years. You now have rates dripping lower. We'll see if we get 2 or 3 cuts this year. And I'll leave that to Joanna and her team, what they think. But that's a significant amount of money that's sitting in money market funds, $8 trillion in assets. We believe that as cuts come, that money is going to get deployed to fixed income products, whether it's active, whether it's out on the duration curve or different types of credit. Massive opportunity for fixed income ETFs to continue to take share.
All right, so those, Joanna, because we are, since Todd broached the subject, we are going to defer to you to this one here. Those bond-based funds, whether they be mutual funds or ETFs, have long been investment instruments and vehicles that people have turned to for that kind of regular paycheck, whether it be on a monthly or a quarterly or a yearly basis. Where exactly then are you seeing some of the best opportunities within that fixed income space, traditionally speaking? We can talk about derivatives and structured products like Todd is saying for some of these other strategies, but traditional bond funds, whether they're in emerging market or otherwise, are now places that people maybe have more relative comfort. So where exactly do you feel that there are opportunities within that relative comfort of bond funds?
Yeah, I hope they feel very comfortable with the income that's back in fixed income since 2022. People were reaching for yield and looking for income to offset volatility for almost 2 decades, once rates sort of went back to zero after GFC. So that advent of more income back in fixed income has been really important in the last 4 or 5 years. So the places that we think investors should be focusing on is credit, in particular investment grade credit. But to be smart about how to use that, you should be moving yourself out on the rate spectrum to BBB, because there's a yield advantage to going out to BBB with basically the same default risk of investment grade, which investors have come to expect rarely, if ever, defaults. So in terms of that safety, locking in or getting exposure to that income dynamic is where we would say you should be. And to be an intermediate right now, because the expectation is, well, we had a zoom up in rates, which is great for income to offset the volatility in your portfolio. We do think rates are going to come down, so now the price appreciation of your bond portfolio is going to come into play versus what people experienced was the interest rate exposure before. So as interest rates come down this year, intermediate we think is a great place to be. It was in the fourth quarter. The intermediate space outperformed most of the other categories across the spectrum in fixed income. So intermediate credit is where we start with. We also like high quality private credit. We think that for what exactly investors are trying to do, they're trying to reach for yield, but they don't want to take on as much risk. So if you're transitioning from that money market space, yet you want to get as much yield as possible, we think you should be looking at private credit. So our product in private credit is right now, it's yielding close to 7% with a duration of almost less than a month and a credit rating in that portfolio of average of A. So it's really important to utilize some of these products that are in the market now. They really can be powerful. I think people like to use some of the derivative products to offset their equity risk, but we want to remind them that the income is back in fixed income, and bonds are not just necessarily the safety part of your portfolio, but also the opportunity and the income set as well.
Todd, with that in mind, given everything that we've now seen, we talked earlier at the top of this program about this idea that we have a changing Fed landscape coming up. Interest rates, I'm not going to say that the forecasts are all over the board, but, they've kind of tightened up a little bit and maybe gotten a little bit more clarity with Kevin Warsh being named as the nominee for Fed chair. I wonder from your perspective how you think the investing landscape for you is either changing, shifting, or evolving over the course of the next few months, given this idea that the Fed is going to be a little bit more variable, I guess, is the best way to put it, over the course of the next several months.
Yeah, I think from the equity landscape, I would expect more volatility, right? So you're going to have a new Fed chair. It's also a midterm election year, and both of those historically bring volatility. It's just how markets play out, right? There's a lot of different variables at play. So I would definitely be looking for volatility. I would think low vol strategies might actually make a comeback here, and those have seen pretty good outflows over the last few years as there's been other replacements in those portfolios. So I think if you're looking in the equity sleeve of your portfolio, take a look at low vol to help ride the storm out. And then in fixed income, Joanna says, and she's right, the income is back in fixed income, whether it's the 2-year, the 10-year, and yeah, the shorter end is dripping lower, but you can start to move out on the duration scale, and you're still going to get a pretty good return there without any sort of credit blowups, I think, that are out there. So I think investors should just realize, hey, If you're too much in the short end, consider moving out on the fixed income space. You can capture that yield and look to say, how can I hedge myself throughout what is expected to be a pretty volatile year, given all the policy variables that are out there going forward.
All right, and Joanna, because you are the bond manager on this panel right now, from a bond manager's perspective, what exactly are you thinking mentality-wise or construct-wise about how you're going to approach the balance of this year, knowing that, you know, to Todd's point, this is a midterm election year, knowing that we have a new Fed chair coming in, whether that's Kevin Warsh, the nominee, or some other strange development down the line. Do you have to kind of change the way that you look at fixed income markets given all of these potential catalysts? Or is this more of a business as usual environment until you see evidence of something actually happening?
I think if you've been, you know, steeped in fixed income as we are every day, you do see the bouts of volatility, you do see the uncertainty coming through in the appointment of the Fed chair. But what we see is a lot of consistency. So for 2026, our outlook isn't much different. But what we do, which is sort of very much a BondBloxx way, is we just help you get more precise during a year like this year. So we still see that credit fundamentals are very strong. Spreads are tight, which also means really means that the economy is strong. There's still really attractive yields and income, as Todd mentioned. So you should be using more fixed income. We like credit. We do like the international exposure this year to help, you know, move people towards, you know, a more diversified portfolio, but also capture some of the attractive yields that are developing there. As we mentioned, like, it's important to look at the full opportunity set. So private credit, so public and private credit is something we want people to look at. So I wouldn't say that we haven't seen defaults. That's been very consistent. But the resiliency, the strength of the economy, and the income, we've been telling that story in 2023, 2024, 2025. The mix is a little different, but there's a lot there still.